Okay, so I'm going to be keeping these really short, and I want to welcome you back to the IModern Experience podcast that we're doing here on YouTube this week and this particular playlist. And in our second episode of the REIT series, we'll dive into one of the most appealing aspects of this investment, and that is the tax advantages. Because understanding these can significantly impact your investment strategy as well as your returns. So if you're going to invest in a REIT, without me saying it, you should definitely sit down with a CPA, your certified public accountant, or your best known tax person to look for the far-reaching benefits as well as the possible consequences of investing in a REIT. And then you want to reverse engineer those steps to know exactly where to get started and how much money that will cost you. Now, REITs offer several tax benefits, primarily due to their unique structure. To qualify as a REIT, a company must comply with certain IRS requirements, and one of which is to distribute at least 90% of its taxable income out to its shareholders in the form of dividends. Now, those dividends are considered taxable income. You definitely want to be aware of that. So these dividends are then taxed at the shareholders' individual tax rate. So whatever tax bracket you happen to be in, if you are investing in a REIT and you are getting very good dividends and it's appreciating, you may be moving into the next tax bracket and you want to know the consequences of what that might mean, right? However, unlike dividends from regular stocks, REIT dividends can be categorized into ordinary income, capital gains, and return of capital. And each one is taxed differently. Potentially, it can be lowering your overall tax bill. So that's where your CPA or tax person would come in, so you know exactly what to expect. Now, take Equity Residential. It's a leading apartment REIT, and by distributing most of its taxable income to shareholders, it ensures that investors can benefit from lower effective tax rates on the return of the capital portion of that dividend, because that capital portion of the dividend is not taxed as ordinary income, but it adjusts the cost basis of the investment, right? So we're not going to go deep into those aspects because my disclaimer is I am not a tax person. I want to give you the overall vision, the high level vision of why this is a wonderful thing to be involved in. But at the same time, the intricacies of this, you're going to need to do that research on your own to make sure that you take care of your due diligence, right? But these tax efficiencies make REITs a compelling choice for income-focused investors, which no doubt you are, or you would not be here. Now, up next, we're going to look at how REITs contribute to long-term wealth building. So make sure you subscribe and turn on notifications and stay informed. And if you have the time right now, go ahead into section 3, as that's what we're going to be talking about next. And I'll see you in the next video.